Ken Barr for Cam's Mortgage Minute on Friday, March 15th. Thought I'd share a report with you that came out earlier in the week and I didn't have get a chance to get around to it. Basically, it was TD Bank, and they had talked about the fact that Canada's real estate bonanza this past decade of long-term trend as one of the most profitable places to invest was basically coming to an end. That Canadian economy had changed, it had shifted, and the real estate landscape was shifting. Also, at the same time, Moodys had done a stress analysis assessment, and they figured that under severe stress, the market could potentially drop up to 44%. And they were citing Canada would join the likes of countries like Spain, as well as United Kingdom and Australia, and basically and be members of the club, where they figured in those same markets, the growth in the housing market in the last 10 years had driven values up so high that the fundamentals had gotten out of whack and it was well overvalued. As with Australia, Spain, and the UK, they expected prices in Canada to suffer most due to the misalignment of current house prices with historical fundamentals. Well, we all know that as prices have run away, certainly job growth and certainly wages and other things have not always kept up. Moody's investors, however, said that no way were they predicting the extent nor the cause of a large-scale house depreciation in Canada. Now, I love these rating agencies because they always have, well, they always take both sides of the street. It's always fabulous because they say, well, we're predicting that the market could potentially do all this, but we're not quite sure if it will, but we're not quite there. But hey, I mean, basically, they're still recovering from 2008, when a lot of the rating agencies missed the subprime meltdown and the basic slowdown, of course, for the U.S. economy, which has gone on, and the decline in the U.S. real estate market. However, I would argue that that decline was as much predicated by the banking system in the U.S. and how it functions. And we do have a totally different banking system. We don't have nearly the competition in our banking system. We don't operate the same way. I mean, in the U.S., there is hundreds of financial institutions. In Canada, we've got, as we know, the big five, and then we've got a smaller handful of institutions. But again, very well regulated and run a little differently. Basically, another agency had come out, and Fitch had come out earlier as well, and they had figured that the Canadian real estate market was not sustainable, and they expected that the home prices were overvalued by about 20%. Now, where all this is leading to will be like everybody else. I mean, we hear this conversation all the time. Where will it all land? I mean, I can't honestly tell you. I have seen personally in the market, prices have already declined. We've, as a recent example, had a client who had a house appraised at over $485,000 just a year ago. The same house today came in at $420,000. Now that's about a 15% correction, so we're certainly seeing it in some parts. Is it going to continue further and further? Well, there's a lot of variable factors that no one can seem to predict on that. As far as monetary policy, public consumer sentiment, global economy, I mean, there's lots of different things that will play in. But the one thing we definitely do know is that the boom that Canada's enjoyed for the last decade or so is come to an end. Whether we're going to be flatlining for a while, I think that personally, that's the way I see it. I don't think we're going to see any growth. Stability-wise, I mean, it's better to have a stable market than, of course, a rising market or a falling market. It's good for consumers overall because there's some predictability in what's going to happen. As far as rates go, we know obviously they're not going anywhere anytime soon. We're seeing, of course, lots of rate wars, lots of great rates out there. So again, like I said, on that front, nothing's changing. But it would be interesting to see, I mean, basically Moody's, when they predicted a 44% correction in dire consequences, they were predicting with the market, the demand fell off the cliff, everything went wrong, that's how much it could potentially drop by. That's a significant drop. Again, a lot of things would have to go very, very wrong. However, Canada is still a country that people seem to want to move to. The savings rates are better than some of the other countries out there. Household debt to income ratio is very high. However, again, savings rates are higher than some of the other jurisdictions that went through similar types of issues. So, are Canadians getting the message? Are they saving more? Are they spending less? Are they borrowing less? Are they taking out less debt? Hey, time will tell whether all of these different messages are going to resonate with Canadians and they're going to follow through. But the bottom line in the interim is that if you are an investor, you're looking for a deal out there, they certainly exist. Whether they'll get cheaper or not, hey, it's anybody's guess. That's it. So, Cam's Mortgage Minute. I hope you've enjoyed it. I look forward to seeing you guys next week. Enjoy your weekend that's coming up ahead. I hope you enjoyed the testimonial we had yesterday for some of our past clients. We are always happy to have your comments, anything you'd like to fire over to me, your feedback. Send me a quick email, call me. Always happy to hear it. Enjoy, again, like I said, your weekend, and I will see you next week.